Welcome to another insightful tutorial on finance. Today, we're diving deep into the topic of scenario analysis. This powerful tool helps businesses and investors anticipate potential outcomes by analyzing different hypothetical scenarios. Let's unlock the secrets of scenario analysis together. Before we delve into the mechanics, let's define what scenario analysis is. Scenario analysis is a process of analyzing possible future events by considering alternative possible outcomes, or scenarios. It's crucial for strategic planning and risk management. Why is scenario analysis important? Well, it allows businesses to manage risks more effectively by preparing for various possible future states. It can help identify both potential threats and opportunities. Let's consider an example to illustrate its significance. Imagine a company called Tech Innovations Incorporated is planning to launch a new product. They use scenario analysis to assess three different scenarios: the best case scenario, the worst case scenario, and the most likely scenario. In the best case scenario, the product is a massive hit, sales skyrocket, and the company sees a significant increase in revenue. In the worst case scenario, the product fails to gain traction, resulting in minimal sales and potential losses. The most likely scenario falls somewhere in between these two extremes. Now, let's break down the revenue projections for each scenario. We'll use a simple bar graph to compare the projected revenues. As seen in the graph, the best case scenario projects a revenue of $500,000. The most likely scenario projects $250,000. And the worst-case scenario projects only $50,000. This visualization helps the company prepare for different outcomes and make informed decisions. But how do we perform scenario analysis step by step? Let's break it down. Step 1. Identify the variables. The first step is to identify the key variables that will impact the outcome. For Tech Innovations Incorporated, key variables could include market demand, competition, and production costs. Step 2. Develop scenarios. Next, create different scenarios based on variations in the identified variables. For instance, in the best-case scenario, assume high market demand and low competition. In the worst-case scenario, consider low demand and high competition. Step 3. Analyze the impact. For each scenario, analyze how the variables influence the outcome. Use historical data, market research, and expert opinions to quantify the impact. This way, you can create a detailed financial model for each scenario. Let's illustrate this with a simple mathematical model. Suppose sales revenue, R, depends on market demand, D, competition intensity, C, and production cost, P. We might formulate it as, in the best-case scenario, market demand could be 600 units, competition cost $50,000, and production cost $100,000. Plugging these values into our equation we get, for the worst-case scenario, let's assume market demand is 100 units, competition cost $100,000, and production cost $150,000. Plugging these values into our equation we get, by using these models, Tech Innovations Inc. can visualize and better prepare for these different outcomes. Let's address some common questions about scenario analysis. Can scenario analysis predict exact outcomes? No. Scenario analysis doesn't predict exact outcomes. It provides a range of possible outcomes to aid in decision-making. How many scenarios should be developed? Typically, companies develop 3 to 5 scenarios, covering best case, worst case, and most likely scenarios. Is scenario analysis only for large companies? No. Businesses of all sizes can benefit from scenario analysis. It's about understanding potential risks and opportunities, which is valuable for any organization. With that understanding, let's consider real-world data. We'll analyze how different economic conditions can impact a company's financial performance using historical data. Here, we look at how the GDP growth rate impacts a retail company's sales over a decade. We will use a line graph to illustrate this trend. Notice how retail sales growth fluctuates with changes in GDP. Analyzing such data helps businesses develop robust strategies for different economic conditions. In conclusion, scenario analysis equips businesses with the foresight needed to navigate uncertain futures. By evaluating different scenarios, companies can adapt their strategies and mitigate risks effectively. Thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe for more insights on financial planning and analysis. Until next time, keep strategizing smart.